Hey there, Erin Bradley here with Fairway Independent Mortgage coming to you live today. And I wanted to address a couple of questions that we have been getting a lot this year, and it's in regards to rental income. So we have three major questions that we run into with our clients in this day and age. And the first one is, can I afford to buy a rental property? The second one is, can I afford to buy a new primary residence and keep my old house as a rental property? And the third is, how does that differ if the rental income is short-term rentals like VRBO and Airbnb versus long-term rentals like a full-time tenant with a lease agreement? So I just wanted to touch base on these things to kind of clarify and shed some light. So if you're buying a rental property, what you need to know is that in most cases, when we look at what we're qualifying folks to buy, we're looking at debt to income ratio. Obviously, your credit score has to be good. You need to have acceptable credit history. And when you're buying a rental property, you also need to have a down payment. And the down payment requirements are a little bit stricter when you're buying an investment property. So in most cases, for a conforming conventional loan, you're going to be looking at a minimum of 15% down payment. If you do less than 20% down, there's going to be mortgage insurance associated with the loan, either as part of the monthly payment or extra money due at closing. And the interest rate definitely gets penalized as the down payment goes from like 25% to 20 to 15% down. So if you're buying a rental property outright, a lot of times folks will do that 20 or 25% down to get that lowest interest rate and ultimately the lowest monthly payment so that the property will cash flow well. Now, if you're buying a rental property and you're wondering, could I qualify for that? I have some money to put it towards a down payment, but could I qualify? Well, what you would want to know is that we can use 75% of the fair market rent on the property that you're purchasing. Now, if you have a renter lined up for a property with a $1,500 mortgage, for example, and that renter is going to pay $2,000 a month, 75% of that is $1,500, which means it would basically cancel out the mortgage payment or the debt on your debt to income ratio. So it would mean that as long as your current debt to income is fine, then buying a rental property and counting that rental income to offset the new debt would be totally feasible. So it's easier than you think. That's number one. The other thing to know is that if you were buying a new primary residence and you wanted to rent out the house you're leaving behind, this is very important because if you're getting a long-term renter in there and you get a lease agreement executed and you have a security deposit with a check that matches the lease agreement deposited in your bank account, then we can actually use 75% of the lease agreement that you have in place. So the difference between the purchase rental property and the departure residence rental property is that on the purchase, the fair market rent is going to be determined by the appraiser. So the appraiser puts an additional form in his or her report, that says, based on comparable rental properties in the area, this is fair market rent, okay? On the departure residence, we actually use the lease agreement. So whatever the person is actually willing to pay. So what you need to know then is if you're buying a new primary residence and you're keeping your old place as a rental, as long as you have that long-term tenant in place, then yes, we can use that 75% of the rental income to offset that debt and it would help you qualify. But again, you would need to have a down payment available. So there are ways to tap into home equity on the house you're living in now to get that down payment on the new place if that's an option that you wanted to explore. What you want to be careful about is that the departure residence rental income, you can't plan for that to be Airbnb and VRBO and still use that income. So with Airbnb and VRBO, because it's not basically a guaranteed, here's the rental income for the next year, it can fluctuate day to day or week to week, then in order to use that income at all, we actually need a 2-year history of you having that kind of income to be able to use it and average it over 2 years. So the third thing that we want to talk about, we talked about buying a rental property, we talked about converting your current home into a rental property, and the third one is that short-term rental income. So if you're buying a rental property in a resort town, for example, and you want to qualify using rental income, and you also want to use it as a second home, that's going to be tricky. If you're going to buy a place, for example, in a ski town like Winter Park, you need to either qualify with that full mortgage payment or qualify with have a full long-term renter in there, which would kind of defeat the purpose of having it as a second home. Now, there are exceptions to every rule. So as I say all of this, I want you to know that you can always contact us because we have some investors that will actually allow the use of that short-term rental income. It does change the types of loans and terms and things like that. So for now, we're just talking about traditional conventional financing. As always, you know I love to geek out on this stuff. So if you have questions, you just contact us. We're going to explain it to you in layman's terms and help you figure out how to build wealth through real estate investing, which is what I'm passionate about, and I'm passionate about helping you do the same. So with no further ado, just give us a call, email us anytime. We love helping you. Have an awesome day.